For most Americans, a home is their biggest investment, a place where they build memories, raise families, and hope to grow their wealth over time. It's not just a roof over your head, but a key part of your financial security and long-term plans for the future. But with inflation rising faster than in recent years, the relationship between home prices and your wealth is shifting in ways that can be hard to predict. Historically, real estate has been a reliable hedge against inflation. When the cost of living goes up, so does your home's value, helping to protect your purchasing power. But in 2025, things look different. Home price growth has slowed dramatically and is now lagging behind the pace of inflation, a trend that's surprising many homeowners and buyers. This means your home's real value, what it can actually buy in today's economy, may be shrinking, even if the dollar amount on paper continues to rise. For homeowners, this can be disappointing after years of rapid gains, as the wealth effect from rising home values starts to fade. For buyers, slower price growth might sound like good news, but it's offset by high borrowing costs and rising interest rates, making affordability a major challenge for first-time buyers and families alike. The dream of homeownership remains tough for many, as high mortgage rates keep monthly payments out of reach and force some to put their plans on hold. Understanding this new dynamic, where inflation, home prices, and borrowing costs all interact, is crucial for anyone navigating today's complex housing market. Recent data shows a significant shift in the housing market's momentum, signaling a notable change from the rapid growth we've seen in previous years. The once red-hot housing market has clearly lost steam, with fewer buyers competing for homes and more properties lingering on the market. According to the S&P CoreLogic Case-Shiller Index, home prices are up just 1.5% year over year, which is actually less than the current 3% inflation rate, meaning prices aren't even keeping pace with the rising cost of everyday goods. For the past 4 months, home values have failed to keep up with the cost of living, so in real terms, homeowners are seeing their housing wealth shrink, not grow. The main culprit behind this slowdown? Persistently high mortgage rates, which have remained above 6% throughout the year, making it much more expensive to borrow money for a home. These elevated rates have pushed many potential buyers out of the market, reducing demand and putting a lid on further price increases. Sellers are now facing a new reality, where bidding wars are rare and sky-high offers are no longer the norm. In fact, most major cities experienced a drop in home prices from July to August, and this decline was steeper than what we typically see during the late summer months. With borrowing costs so high, affordability has become the defining issue in today's housing market, fundamentally changing how buyers and sellers approach their decisions. The national slowdown hides big differences between cities. Affordable markets in the Northeast and Midwest, like New York, Chicago, and Cleveland, are still seeing price gains. Meanwhile, former boomtowns in the Sun Belt and West, like Tampa, Phoenix, and Miami, are now seeing prices fall. These areas overheated during the pandemic and are now correcting the fastest. Expensive markets like San Francisco and San Diego are also posting declines as buyers pull back. In contrast, cities with stable economies and more affordable homes are holding up better. Buyers priced out of costly regions are turning to these markets, propping up values there. The result, a fragmented market driven by the search for affordability. Not all home price data tells the same story. The S&P CoreLogic Case-Shiller Index tracks price changes for the same homes over time, focusing on 20 major cities. The FHFA index, meanwhile, covers homes with conforming loans, leaving out many luxury and low-end properties. These differences can lead to different numbers. In August 2025, Case-Shiller showed a 1.5% gain, while FHFA reported 2.3%. FHFA's data also suggested more stability month to month. The takeaway? Look at the overall trend, not just one report. Both indices agree. Home price growth has slowed sharply, and high mortgage rates are the main reason. Multiple sources help paint a clearer picture of what's really happening in the market. The future of the housing market depends heavily on mortgage rates, which influence both buyers and sellers' decisions in profound ways. If rates fall further, more buyers could return to the market, boosting demand and helping to stabilize or even increase home prices in many neighborhoods. Lower rates would also encourage current homeowners to sell, since moving becomes more affordable, which could help ease the ongoing inventory crunch and give buyers more options. But timing the market is tough, Waiting for the perfect rate or price rarely works out, and trying to predict future trends can be risky for both buyers and sellers. Buyers should focus on what they can comfortably afford now, knowing they can always refinance if rates drop later, rather than waiting and potentially missing out on a good home. Sellers need to adjust their expectations. Bidding wars are rare these days, and realistic pricing is key to attracting serious buyers in a more cautious market. Well-priced homes in desirable areas still sell, but patience is needed, as it may take longer to find the right buyer than in the past. The market is more balanced now, with buyers having more leverage and negotiating power than in recent years, making it a less frenzied environment. Ultimately, affordability, not just the sticker price, is now the driving force in real estate decisions, shaping the future of the housing market for everyone involved.